So the Federal Reserve might lower rates today. It's Wednesday, September 18th at 2 p.m. Eastern Time. They're going to announce those rate cuts. You hear about it all over the place on the media. It's going to be amazing. You'll get out of debt like that. Car loans will plummet. Personal loan rates will plummet. Credit card rates will plummet. You'll be able to remortgage your house, refinance it, you name it. No. It's going to be negligible. It's barely going to make a dent. Let's talk about it. And then let's talk about what you can actually do to help yourself get out of debt and get ahead. I call this the dollar is dead because what the rich do is they don't hold dollars, they hold assets. And they are out of debt unless it's what you would call good debt that helps them make more money. Credit card debt, things like that, bad debt. We want to get out of that. The government doesn't care about you. Banks don't care about you. You have to take control of your finances because real freedom is financial freedom. So 3 days a week I do this, and on Fridays we talk about how you can invest to make your assets grow, beat inflation, and do what the rich do. During the week, either Monday or Wednesday or both, we talk about how to get out of debt. That's what we're going to talk about today. And you're hearing all this hoopla about the Fed rate this, Fed rate that. What does it really mean? So let's talk about that for a second. The Federal Reserve has meetings. They've got this month, September 18th and 19th. Then they have meetings in November, meetings in December. So everyone's been talking about, will they cut rates? Rates were around 0.25%. That was around March 2020, I think, when they were that low. And then to March 2022, they stayed that low, around 0.25%, 0.25%. Then it was July of 23 when they had gotten up to their highest point of 5.5, which is where they sit now. People are hoping, or the markets and some, that they might lower rates 0.25 point, which would be 5.25, the Fed rate, or 0.5 point, which would be 5, and then or 4.75, which would be 0.75%. Okay. What does that really mean? Well, let's look at right now credit cards, personal loans, cars, mortgages. Average credit card rate, it has been around 24, it's 24.92, it's 25%. That is outrageous. It's been that way for a long time. The site shows it month by month. Then we're looking at personal finance. A personal loan is around 22%, 21%. They've got some, depends on your credit score and that sort of thing, but on the average, that's incredibly high. Then, not prime, in other words, not the best for car loans, not the lowest credit for car loans, but middle of the road, you're looking at 10 to 14% for a car loan. That's substantial. And then you all know and probably follow what mortgage rates are. Well, it comes to how are these affected? Credit card rates are usually affected the most. They're tied pretty much to the Fed rate. So what does that mean? Well, if the Fed drops what they think would be a lot, which is 0.75%, that would mean this 25% rate would go to around 24.25. Is that a big deal for you? Is that going to make a dent? No. All right, let's move on. Personal loan rates. Now, personal loan rates and car loans are probably next in terms of being closer tied to the Fed rate, but a 0.25 point drop doesn't usually result in a 0.25 point drop in car loans. It's usually less than that. But let's just say it was. Let's just say they got the maximum of 0.75%. They'll call that 75 basis points. That would take this 14% loan to 13.25. Whoop-de-doo. That's not making a difference either. Personal loans, 21%. They may come down a little bit. Mortgage rates, not really tied to the Fed rate. It's more the long-term 10-year Treasury notes. We know that because time has shown that. However, this year, rates have not been lowered, yet mortgage rates have come down. Okay, so what am I getting at here? That all this talk about the Fed lowering rates and how great that's going to be for you, well, it may affect other things like inflation of that sort of thing, but it's not going to affect the car loans. You're not going to want to refinance. It's not going to drop the credit cards to the point where let's take on a little credit card debt because we're getting debt so cheap. No, that's not happening. That's not going to make a dent. So what can you do? Here on my channel, if you just click I guess it's my handle, Hack Your Credit Cards. You'll go right to the channel page, and there's different lists. If you haven't done this before, as you move down, this first list here, Get Out of Debt Guides to Conquering Your Debt. These are all the different shows I've got to help you get out of debt. And if you click the title, it'll list all of them. And a lot of them, these are videos with different ways explaining. I've got whiteboard videos explaining how to get out of debt with things like the snowball method, the avalanche method, whatever it may be. And then I've got videos on calculators to show you exactly how you can calculate how much you would save. And let's get right to that. On the site itself, I've got calculators. I'll put a link to these calculators: credit card calculators, car loan calculators, mortgage calculators, general debt reduction. These are ways to help you get out of debt when it comes to car loans and credit cards, etc., and different calculators for that. So I'm going to show you one, and I'm going to make a quick point. When I was getting out of massive debt years ago after a divorce and all these problems, I realized that, and I think this is obvious, but a lot of people get in the weeds. You look at your budget and you want to make a dent in your budget. You want to spend less so you can take more money and apply it to your debt to pay off your debt faster. Makes complete sense. But why am I looking at something that is a monthly recurring $10 expense when I might have a monthly recurring $800 expense? Okay, so this streaming service might be $10, but my restaurant bill every month might be $1,000. Well, which one should I attack first? Go after the big one. What's my point? My point is the Fed rates dropping by 1/4 of a point, that's not going to really make a difference. Don't think, oh, I'm going to go out and refinance my car right now because I can drop my loan by 1/4 of a percentage point. The savings are going to be negligible and may be wiped out by the fact that there might be all sorts of expenses and costs to getting a new loan. But if you've got something like $1,000 restaurant bill and you can get that down to $500, that's a $500 savings. That's big. So don't let the media and everyone confuse you and make you think that this Fed is such a huge deal. Let me show you just this one simple calculator, the credit card payoff calculator. I've got a video on how it works, but it's very straightforward. What's the balance on your card? I just put in $10,000. What's your percentage rate? 24%. What's a monthly payment? Whatever you're making. You might make your own payment or they might have a minimum payment. But let's just say, for sake of argument, it's $500. You hit calculate and it tells you over time you're going to pay $2,900 in interest. So you're going to pay the full $10,000 back plus the $2,900. So that's $12,900. It's going to take you 26 months to pay it off. Okay, here's what you can do. You can choose to say, I'd like to pay it off in a certain number of months. It'll tell you how much to pay every month. But here's the kicker. If you're able to decrease your budget, find a couple $100 a month. Let's say you got an extra $300 somehow. You wiped out a streaming service, you lowered the amount you pay on restaurants, you carpooled with a buddy and your gas got cut in half. That can make a big difference. So you say, I got an extra $300 a month. Will that matter? What'll that do? Well, here you go. You just click calculate. It shows you the initial. And then it says with an additional payment of $300, you would pay off your credit card. And it tells you the date, saving $1,275 in interest. So total interest paid would be $1,624. So you're saving $1,300 and you'll pay it off in 15 months instead of 26. That means at the end of 15 months, you no longer have this $800 payment. That goes away. So you've got $800 available because the minimum payment is gone, plus the additional you're putting down in just 15 months. You don't have to wait till over 2 years. You're going to do it in less than a year and a half. That is substantial. So forget all the hoopla around 1/4 point, 1/2 point. Not going to make a difference. Go after the big items, the big debt items with the highest percentage rate, like a 24% credit card. Go after your highest percentage rate debt first. Apply as much as you can because whatever extra you pay, you're paying the principal down. And you can usually make extra payments on everything. Contact the company, make sure you understand how to send in extra money, either online or mail it such that it goes to principal as opposed to just prepaying future payments. You want it to go to principal, they'll pay it down faster. I hope that's helpful. Again, on Friday, I always talk about ways in which you can invest to grow your net worth, to not get wiped out with inflation. So I hope this is helpful. Have a great day.